Welcome to TheoTrade. This is Don Kaufman. It's May 6th, 2018. You are watching the Theo Weekend video. Let us start with a quick recap, and specifically a recap of the S&P futures. Now, for many of you, you might not necessarily trade the S&P futures, and I understand that. However, the S&P futures, they drive order flow to the entire marketplace. And what that effectively means is when I say, the futures are moving, well, so goes the market. And to kind of further that, right, as the futures move, literally buy and sell orders are generated into pretty much every component of the S&P 500. And that's actually one of the large themes of the last few weeks of trade, to understand that, again, watching the S&Ps bounce, okay, and really just ripping back and forth from level to level and driving the rest of the S&P 500 higher or lower with whatever those futures contracts happen to be doing at any given point in time. And what this really relates to is what we term correlation. And we've had extraordinarily high correlation in the last couple of weeks in the marketplace. And what I want to show you to kind of kick this weekend's video off is some of that correlation. Now, all I am currently looking at happens to deal with the S&P 100. Now, obviously, we could pull up the S&P 500 here, but it's the S&P 100. It's this kind of market cap. And I mean, if you made it to the S&P 100, these are the market caps that really drive, again, a lot of the order flow out there. So, how is the S&P futures, like how are these ES futures related to this basket of stocks? As the S&P futures move, whether it's up or down, literally there's servers that will drive buy and sell orders to every single component, all right, for example here, of the S&P 100, and they do it simultaneously. Now, people often think to themselves, hey, I'm going to hop on that type of trade. But as the S&P futures move, the servers generate orders. I mean, they're, quoting in nanoseconds. I mean, we're talking billions of a second. But the reason that I'm kind of focusing on this right up front here on this weekend's video is that correlation, okay, coefficients are extraordinarily high. And what that again means is if you look at the advanced decline line from back to Friday's trade, well, the market rips to the upside, and we'll kind of zoom out for a second. The S&Ps close up 32. For the most part, you didn't have to think very much about, hey, what went up and what went down, okay? Because it doesn't really matter. It means that the market, right, is trading as almost like a cohesive unit. It's not like this autonomous, underlying. Now, and that has a lot to do with the fact that, yeah, we're through many of the earnings. And of course, you're going to have a few of the odd stocks out, sometimes because of the earnings announcements. Nevertheless, I want you to think about these heavy correlations in the days and weeks to come, because what it effectively means is when you start to look at the S&P futures, you can save yourself a lot of homework. You can look at the financials, you can be looking at Netflix, you can be looking at Google, but hey, those underlyings are going to be, subjected to whatever the S&Ps are going to do, especially when we're in high correlations. And in these high correlations, you'll see it to the upside, you'll see it to the downside. I mean, there'll be days where you're laughing, days where you're crying, and it has everything to do with the fact that order flow is flying into the S&P futures, okay, and literally shifting every stock in the S&P almost, all right, on 100% correlation. Again, this is a 93 products in the S&P 100 to the upside. And when we saw some of the sell side activity, specifically on Thursday, at one point we had 96 products down in the S&P 100, which brings me to my next point. Let's talk a little bit about some of these levels. So it has been now almost 2 months. Now I'm just showing you the last 5 days of trade, but it's been almost 2 months that I've started talking about just pinging back and forth between, okay, some levels. We call those levels gravity points. And if you've tuned into any of these videos, right, you would remember these levels because I write them down almost every day. This is 2682 up top over here. Right here happens to be 26, all right, 26. And when I say pinging back and forth, I mean, it is almost crystal clear. That's 2682. I mean, literally hit it for a high on the button on Monday, came down on Tuesday, stopped on a dime at 2626, took back off to the upside. But wait, there's more. We skirted 2626 for a while on Thursday, broke to the downside. Now, to the downside, there does happen to be another key level down here. That's 2575, stopped just shy of it, rebounded, traded overnight to 2626, cracked lower, and exploded higher off of it. And I'm just bringing this up because if you're trading on an intraday basis, you should be using these levels. And again, I don't want you to think of this as, support and resistance. When I call it a gravity point, it's the market literally getting pulled to it. When we hit these gravity points of like 2626, do not, as I said, look at this as support and resistance. When you hit the level and we start to what I call push off the level, and when I say push off the level, it means once you get about 5 or 6 points, okay, off one of these key levels. For example, right now we're on this 26, okay, 26. You get about 4 or 5 points, maybe even 6 points off the level. You'll actually push off of it. And pushing off of it means, you're literally getting pulled off the gravity point and exploding higher and or lower. And you will see this time and again. So there's a lot of us that are trading now on an intraday basis, watching us come to a key level, one of the gravity points. And just as we, start to trade off one of those levels, all right, if you're so inclined, again, you're 5 points off the level and you realize at that point that you have a pretty good chance of pushing off, get long. It's, again, become really relative on a day-to-day basis. Specifically, I'll knock out now to a 30-day. This is a 30-day 1 hour. And again, this is all we have been doing. And I could back up even further. All right, these are the same levels. That's 2682. Here's the 2575, 2626, and just pinging back and forth between them. And I'm spending so much time in this because it's imperative to understand that's what the market's doing. With that, I'm going to cruise right over to the SPX. And the reason I'm going to go to the SPX, let's zoom in, okay, and tightly zoom in on the SPX, some of the expected moves that we've seen. So what we're looking at right now happens to be, again, our expected moves, just the last few weeks of trade. All right, here we had kind of a upper 40s expected move. We dropped to about a $42 expected move, and this next week we are looking for right around a $40 expected move. That means the S&Ps are priced to move about 40 bucks higher, 40 bucks lower. Now, there is one thing that is quite impressive in just the last few weeks of trade, and that's this. We've started, okay, to stay back inside of some of the expected moves. So here we are, okay, just a few weeks into this, and there's 1 week we stayed inside the expected move. When I say stay inside of it, by the end of the week, we stayed inside what the marketplace anticipated. All right, so as I kind of draw these, yes, during portions of the week we cracked outside the expected move, but what we've got right now is 1, 2, 3, 4, 5 weeks we've stayed inside what was anticipated by the marketplace. Now, that's important. Now, does that tell you, should I buy premium? Should I sell premium? Yeah, that's exactly what I'm getting into. The one thing I want to kind of caution you of, just because we're staying inside the expected move doesn't mean you should run out and like, I'm going to sell some option premium. We're staying inside what was expected, because you could theoretically just sell options out here, and then what do? You get down on your hands and knees and you just pray, please do not breach the expected moves. Nevertheless, I want you to see some of the breaches throughout the course of the week. I mean, it doesn't really matter who you are. Okay, a breach of the expected move. If you've sold premium, I'm kind of zooming in right here. I mean, that is a wild breach of expected move. But the thing that I want to make very, very clear is that, once again, these expected moves, they're holding tremendous weight on an intraday basis. And that's why I wanted to spend, again, a little bit of time on the S&P futures, and I also wanted to spend a little bit of time, I'm even going to zoom in to some intraday trade, if you will. So I'm going to come down to time frame here, and I'm just going to back this up to about 3 days and knock the time frame out to about 15 minutes. Okay, and again, this includes some of the overnight trade. But the SPX, All I wanted to show you is, okay, the lines that you see on the screen, they're the expected moves. So the expected move, and this happens to be the lower end of the expected move for the week. And when I say that the marketplace is starting once again to adhere to the expected move. All right, here is Thursday. Thursday, we opened on the edge. This is the lower edge of the expected move. Market breaks down hard, comes back up, literally ends the day inside of the expected move. Again, as I said, this is the lower end of the expected move. This is the central point. And pretty much by week's end, we ended up, all right, directly on kind of where we started the entire week. In fact, an interesting irony, the last couple of weeks of trade, if you do look at the last couple of weeks of trade, all right, here's 1 week, here's 2 weeks, all right, for instance, 3 weeks. I mean, we are in an extraordinarily tight range. 3 weeks of trade, we've seen lots of intraday volatility. But if you looked at this like on a weekly, it would look like absolutely nothing. Like, what has occurred? Everything. What was the outcome? Nothing. And that's one of the points I want to make. I am at the point where, and again, I'll make a little bit of an opinion call over here. I think we're just about, and I want you to recognize this, I think it's just about done with some of the ranges that we've seen lately. And this is something Doc Severson has actually spoken to quite a bit. But if you look at like the last 30 days, in fact, I'll even knock the time frame out here to all the way to the last 90 days for 2 hours. Okay, and you'll realize how much we're pinging in back and forth inside of these levels, and it does look like we are ready to succumb to the edge of those ranges. So now, of course, the question is going to be, which way are we going to go? Well, again, we've got high correlations. So you're going to want to look at the S&P futures. You're going to want to examine the Nasdaq. All right, we've been bouncing off and around the expected move. But again, this coming week, we're looking at what? About a $40 expected move. And it's hard at this point. It's very hard for me to fathom that we're going to stay inside the expected move in this coming week. Listen, we're still just chock full of news, and there's Twitter bombs dropping out there on a day-to-day basis. A $40 expected move. Okay, I would at the very least expect breaches of this expected move throughout the course of the week. And what that does mean to me is on an intraday basis, once again, you better believe I'm going to be buying some premium. Now, before I go any further, because I am going to talk a little bit more opinion about, where we think the market is headed in the very near term, I want to back up for just a second. I want to talk about the previous week. One of the things that kind of struck me is we were really concerned in this previous week because there was so much news and so much information. But, when it comes down to the Fed, I'm at the opinion now, you need to just tune out. They're not going to do anything that's like, unforeseen at the Federal Reserve. Jerome Powell, listen, they're just going to continue this gradual increase of rates. They have already kind of stated both of the Fed's major boxes have been checked. What are those major boxes? Employment, right? Employment. So that actually brings me to the Friday jobs number. Did anybody care about the Friday jobs number? No. The market rallied. The market sold off. It laughed. It cried. The jobs number came in a little bit weak, but it doesn't matter because the unemployment dropped to 3.9%. Yada, yada, yada. Nobody cares no more. When it comes to the Fed, it's the exact same animal. What are we going to do? Nothing. And I'll see you in 6 weeks when they're going to entertain the idea once again of raising rates. So you're going to get a gradual increase of rates, which brings me over to the TNX. Now, this is where I'm going to start to get into the discussion of what do you think we're going to see in the markets in the near term? I am on a day-to-day basis. You come into the markets on a day-to-day basis. The market each day almost feels like a coin flip. Now, we've had some great intraday trade. When I say the market feels like a coin flip, well, if you looked at the S&Ps, one day we popped above a level, the next day we popped below that level, and we're just trading, okay, on, from this inflection point of 26.26 on a day-to-day basis. Flip a coin higher, flip a coin lower, that's all right. However, we're in a rising interest rate environment, and I've said this time and again, but the Fed, they ain't got your back anymore. Now, everybody's got their eyes focused on the interest rates. Now, this happens to be the TNX. It's the 10-year Treasury, and you can see, of course, it hit 3%, backed off a little bit. But here's the bottom line. This, okay, psychologically impacts the market. But the reality is, hey, nobody really cares on a day-to-day basis. Higher interest rates are absolutely coming. And my reasoning, and I'm going to give you a broader picture here. Many people will recognize that I am bearish on the markets, and my reasoning for being more bearish on the markets, it has everything to do with interest rates, but it doesn't necessarily have to do with people are like, well, as the interest rates go higher, it's going to be hard to pay off student loan debt. It's the mortgages, and it's going to hurt the housing market. That isn't actually my argument at all. As the interest rates start to creep up, major trading firms, big trading firms, right? The banks out there, they all borrow capital. And all these banks and firms are capable of borrowing capital for the most part at next to nothing. But those short-term rates, not the TNX, all right, not the 10-year treasury, the short-term rates, and those are the ones that the Fed is raising, right? The Fed fund futures, which actually impacts some of the T-bills, the really short duration paper, that's the stuff that's really being impacted. And what it does to trading firms is it causes their cost of carry to positions to go up, right? What that effectively means is there's a whole lot of big trading firms out there. They carry monstrous positions, not necessarily bullish or bearish, but they have huge amounts of leverage in a marketplace. And when the interest rates start to appreciate, especially substantially so, like we have seen, these firms are going to have to deleverage their positions. And in delevering their positions, which is an okay thing, we're going to get continued volatility. That doesn't necessarily, portray just a straight bearish condition for the marketplace. Okay. It does absolutely portray, though, that we're going to see continued volatility. We're coming now, we're in May, we're going to be coming and turning the corner right to the summer, and everybody's, summer, it gets kind of boring out there. People, I don't think this is going to be a boring summer. I have a feeling we're going to be rocking during this summer because we're going to be driving rates higher throughout the course of the summer. So there is a tremendous amount to think about on that front. One last thing I want to cover, all right, happens to be, you look at the market, it rallied later in the week, and you're like, oh, breath of fresh air, I'm going to be okay. And then I have tendency to look at, things like volatility futures. The VIX backed off to 15, but hey, I'll spend a minute just glancing at the VIX with you. I am not into VIX technicals at all because it's just a derivative, but the VIX seems to have found a floor at about the 15 level. But let me show you something interesting about the volatility futures. The volatility futures themselves, you got to look a little bit further out in time when you're looking at these vol futures. And there is something interesting, and this is one of the last things I'll leave you with. If you're kind of curious, are we going up, we're going down? Look at the 45-day volatility futures. They're trading at about 1636. Then you come out to these 73-day volatility futures, okay? And they're trading at about 1677. Then you come even further out, 108 days, and they're trading what? Almost the exact same price. Now, this is what some people term the contango, the backwardation. Here's the interesting thing about markets right now, and when it comes to the volatility futures are pretty much flat. All right. When I say pretty much flat, this means short duration risk is almost identical to the longer duration risk. And what that effectively means is we have truly hit this just absolutely key kind of inflection point where we could explode higher or go lower. The volatility futures right now, okay, indicate absolutely there is risk here. We are teetering on possibly selling off, but at the same time, they flattened out the vol skew because, again, what it means, risk right now is about the same as it is 108 days out. And that is indicative, again, of trading firms being very much guarded. As I said, we're looking for this really tight kind of pinging back and forth range to be broken. Okay, in effect, what I would expect this next week, what I would, specifically get into this next week, I believe we're actually going to rip higher, ultimately then to turn back around and head lower. Okay, undoubtedly, I have been bearish on markets, and we've had some great moves, some great volatility. But now it does appear it's time to crack these ranges. Thanks everybody for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.